After Google's latest earnings result, the stock is down by as much as 9% before recovering a little. This was due to Google missing earnings expectations. I wanted to go through Google's earnings and why I think the stock went down by so much and whether Google is a buy now. So without further ado, let's jump right in. Looking at the news report, it was reported that Google missed several expectations. For example, analysts were expecting revenue to come in at $96.56 billion, while it only came in at $96.47 billion, which is a little funny because it was just a 0.09% miss. Not just that, Google also missed on its cloud revenue. Analysts were expecting Google Cloud revenue to come in at $12.19 billion, but Google only delivered $11.96 billion, which again is just a very small difference. But other than that, Google numbers came in strong. EPS came in at $2.15 versus the $2.13 analyst expectation. YouTube advertising $10.47 billion versus the $10.23 billion expected. And if we look at the financials itself, everything has been growing really well. Google full year revenue came in at $350 billion as compared to the $307 billion revenue last year. And you can see that the revenue has been steadily increasing over the years. Net income also grew from $74 billion to $100 billion. While net income is a little more choppy, the overall trend is still up. Same for free cash flow, which has gone up over time as well. The reason free cash flow growth has somewhat slowed down over these past few years is because Google is heavily reinvesting into itself. For example, here we can see that in 2020, their capital expenditure was just $22 billion. Okay, I didn't mean just as in the amount is little. $22 billion is a lot of money. But in 2024, this has grown to $52.5 billion. So it's more than double of what Google was spending. So everything looks fine and the company continues to grow. But despite all that, Google is trading at a much cheaper valuation as compared to the rest of the Magnificent 7 stocks. For example, while Google has a PE of 25, Apple has a PE of 37, Microsoft is 33, Amazon is at 50, Nvidia 49, and of course, we have Tesla trading as though it's on the moon and has a PE ratio of 185. So then, what is causing Google to trade at a much cheaper valuation as compared to the rest of its peers? I think there are two challenges or two uncertainties that are facing the company. The biggest worry right now is that US Justice Department wants to force Google to sell off their Chrome business. So what happened was that back in August last year, the US courts ruled that Google has an illegal monopoly on search. That's because Google was found to be paying $20 billion a year to companies like Apple, LG, Motorola, Samsung, and so on to be the default search engine in their browser. And they argue that because Americans deserve an internet that is free, fair, and open for competition, they want Google to sell off the Chrome. Now, most people would think, isn't Google Chrome just an internet browser? Why would the Department of Justice want Google to sell off their browser? Right now, Google Chrome owns around 65% of the browser market share. For most people, whenever they get a new Windows laptop or MacBook, they would first open the default browser, which is Microsoft Edge or Safari, and download Chrome. This is their default browser, and it is their default gateway to the internet. Now, while it is true that Google doesn't directly earn money from Google Chrome, Google benefits a lot when people choose to use their browser. Quick pause. If you are looking for the cheapest broker to start your investing journey, check out Interactive Brokers. It has the lowest fees for stocks, ETFs, options, and more. Not just that, Interactive Brokers lets you easily research stocks. Like, you want to check out companies' financials? Here it is. You want to check out analyst ratings? Here's a bunch of them. It even has free technical insights which tells you where the stock might possibly go next. So sign up to Interactive Brokers today and let's get back to the video. For one, Google Chrome provides Google with extensive user data like search queries, visited websites, and browsing patterns. And yes, even if you are in incognito mode trying to secretly buy flowers for your girlfriend, Google is still tracking you on Google Chrome. This allows Google to improve the efficiency of their ad targeting. Like here, based on my online activity, Google knows that I'm interested in investing topics, credit cards, healthcare services, and so on. And from there, they will show me more ads that are related to these topics. Besides that, user data from Chrome can help Google to further refine its search algorithm, thereby allowing it to constantly improve the relevance of its search results. Not just that, Google can also use Chrome to reach a wider audience and promote other Google services like Gmail and YouTube. So Chrome is very important to Google's business, and the more people use it, the more data Google has to improve its ads relevance and revenue. However, I think there's a very low likelihood that Google will ever sell Chrome, because right now we are trusting Google to protect our privacy, for better or for worse. By selling Chrome to a third party, it can potentially endanger the security and privacy of its users, because we wouldn't know what the third party will do with our information. Now, of course, maybe instead of forcing Google to sell off its Chrome business, they could just force Google to stop paying other companies to make Google as the default search engine. This could also work, right? That actually happened in Europe, where in 2021, Google was required to allow users to choose their default search engine. But guess what? Even after years of doing so, there was no noticeable change in search engine market shares, as most people still continued to use Google. The other reason I say Google will have a low likelihood of breaking up is because in the past, the same thing actually happened to Microsoft. So back in 1998, the US regulators felt that Microsoft was too big and wanted to break it up. This whole process took more than 21 years, a time long enough for our boys to become men, before the regulators finally gave up. And probably a big reason why Google will never be broken up is because, fortunately or unfortunately, US companies spend a lot of money to influence US politics, and this can greatly help Google in their case. But of course, there's always a small possibility of the regulators succeeding in breaking up. In that case, what will happen to the share price? Believe it or not, this is actually good for Google, because in the past, whenever companies were broken up, their values were unlocked as a result. For example, back in the late 1800s, there was this company called Standard Oil, and it was the same story all over again. They got too big and the US government wanted to break it up. When they finally broke up, Standard Oil's entities grew 5 times larger after its separation, and it made its shareholders very rich. Or a more recent example, in 2023, when Alibaba announced that they wanted to break its business up into 6 different units, the stock shot up by almost 20%. In short, there's nothing much to be worried about when it comes to Google breaking up. Now, perhaps a much bigger concern that Google is facing right now is that AI, or large language models like ChatGPT, Meta, Perplexity, and probably even DeepSeek are disrupting Google's search. The reason everyone is worried is because search advertising is Google's largest revenue source. It takes up almost 57% of the overall income, and if search was disrupted, it could threaten Google's dominance and advertising revenues. However, it has been over 2 years since ChatGPT and all the AI tools came out, and since then, we have not seen any real impact to Google's search revenue. It has continued to grow at a steady rate. But maybe this is still too early. Perhaps we can argue that the breakthrough is not here yet, and it will come sooner or later. That's certainly a possibility. However, what's also true is that over time, Google's revenue is actually becoming less and less concentrated on Google search, as other segments are starting to grow faster than Google search. For example, YouTube ad revenue is increasing. Other revenues like hardware sales, app sales, service fees, subscription and licensing fees are also increasing. But the fastest growth of them all is Google Cloud. It has been growing at a 35.9% CAGR since 2019, as compared to the total revenue, which is just growing at 15.9% CAGR. In fact, Google Cloud is growing so fast that in the latest earnings call, Google said that there was more demand for AI products than the supply that they have. That's why their cloud revenue fell short of estimates. Not because demand was low, but because they couldn't keep up with demand. Because of that, Google plans to spend even more capex to bring on more capacity. In 2024, their capital expenditure was $52 billion, and in 2025, they plan to increase it further to $75 billion to build more infrastructure and data centers. These are the kind of investments where once you build it, it will continue to bring in revenue every month. Also, not forgetting that Google's Waymo has been growing too. Waymo is Google's autonomous vehicle, and while Tesla is still struggling with rolling out their FSD, Waymo has achieved 150,000 weekly paid rides and will be expanding to 10 new cities in 2025. Then there's also progress with Google's own AI, Google Gemini, as well as the quantum computing chip, Willow. In short, I believe that despite various challenges that Google is facing, their future is still bright. Next, besides just the PE ratio, I also wanted to see how cheap or expensive Google is. So here, I did my own intrinsic value calculation. I tried plugging in the numbers that I got from Yahoo Finance, which admittedly still doesn't have the latest numbers, but this would do. I then looked at various websites like FinWiz, GuruFocus, and FinChat, and found that on average, they projected that Google to have a 16.64% growth rate over the next 5 years. But I wanted to be a little more conservative, so I assumed that Google would just grow at a much slower rate of 10% for 5 years, then 6% for the next 5 years. And even then, I ended with an intrinsic value of $234, which represents a 22% upside from current levels. I also went to check GuruFocus and found that they had a similar fair value of $247. And if I open up Interactive Brokers and look at analyst estimates, all of them were also giving around $220 fair value. Now, of course, I'm not suggesting that Google will definitely rise to that price in the near future. No, this is a buy or sell recommendation. All I'm saying is that based on what we know today, barring any unexpected events, Google is an attractive investment. So do let me know what you think. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.